How to account for earnings releases with IVP. Have you ever wondered how to navigate the tricky waters of options trading during earnings releases? Understanding Implied Volatility Percentile, or IVP, can be a game changer. Earnings announcements often lead to significant price movements and volatility spikes. This is where IVP comes into play. It measures where the current implied volatility stands compared to its range over the past 52 weeks. Knowing this helps traders determine if current implied volatility is high or low relative to historical levels. To effectively account for earnings releases with IVP, start by recognizing that earnings announcements typically cause sharp price moves. This leads to increased uncertainty, which causes implied volatility to rise sharply before the event. When this happens, you will often see a high IVP, indicating that options premiums are elevated due to expected volatility. Next, use IVP to gauge relative option pricing. A high IVP before earnings suggests that options are relatively expensive compared to their historical levels. This can influence your trading strategy. If the IVP is very high, selling options, like straddles or strangles, might be an attractive option. This strategy allows you to capture premium while anticipating a collapse in implied volatility after the earnings announcement. Conversely, if the IVP is low or moderate, you might consider buying options to benefit from a potential volatility increase, although this is less common before earnings due to typical volatility spikes. It is also important to incorporate IVP with historical volatility and expected price move estimates. Remember, IVP alone does not predict the direction of price movement but signals the expected magnitude. By combining IVP with historical volatility and expected earnings move estimates, you can assess if the current implied volatility adequately reflects the anticipated earnings impact. If the IVP is high and aligns with expected earnings volatility, options prices may reflect the market's consensus on potential moves. Additionally, be aware of fat-tailed earnings returns. Earnings-related price moves often have fat tails, meaning extreme moves are more common than in normal distributions. While IVP captures volatility expectations, actual earnings moves can exceed typical forecasts, leading to unexpected outcomes even with high IVP levels. Lastly, timing and strategy considerations are key. Monitor IVP in the days leading up to earnings to identify when implied volatility peaks. After earnings, consider closing or adjusting option positions, as implied volatility typically collapses, leading to premium decay. Use IVP to compare current volatility against historical norms, helping you decide whether to enter volatility-based trades or focus on directional strategies. In summary, accounting for earnings releases with IVP involves using the percentile ranking of implied volatility to understand how expensive options are relative to their historical volatility environment. This knowledge helps you make informed decisions about option pricing, risk, and strategy around earnings.